Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. In today's video, we're going to talk about how can you really identify stocks that you can add to your portfolio that will be winners in the long run. And I want to make something clear. This is a video for investors. It's not for speculators or day traders. It's for those people who are prudent, conservative, long-term investors that want to have as much confidence as they can in owning stocks that they believe will take their portfolio's performance where it needs to be to satisfy their own unique goals, objectives, and risk tolerances. So there's a couple important questions that need to be answered in order to do that. Number one, how do you know if a stock is a good stock or not? The secret is it comes down to the quality of the company behind the stock. And it's not all about stock prices and stock price movements. That's, I think, where a lot of investors get in trouble. So how do we identify the right stocks? And then the key is, when do you buy the stocks? How do you confidently invest in a company, recognizing that you're getting full value out of the money that you're investing? We're going to cover those subjects and more in today's video. So let's go ahead and turn to FastGraphs, and let's look at what makes a company a good company and what makes a stock a good investment for long-term investors. Now, as usual, I'm going to use the FastGraph Fundamentals Analyzer tool, but I also want to take the opportunity to introduce a feature that has been asked for by a lot of people. This is how FastGraphs looks today. This is not a complete graph. This is only a graphing of the earnings of Tupperware here, and that's going to be a secret to what we're going to talk about. But I want to go into the settings here, and I'm going to go into dark mode. And so a lot of people have asked for a FastGraph dark mode, so we're going to do today's video utilizing the FastGraphs dark mode feature that we've just added to the tool. So now, one of the real advantages of FastGraphs is that it gives you a clear perspective of the type of company and the type of success that the company you're investing has. Because one of the secrets we're going to talk about here is that in the long run, earnings determine market price. Now, that can be said a lot of different ways. In this case, we're plotting earnings, okay? It can be looking at, you could say, fundamentals determine market price. In other words, what drives the price of a stock in the long run is how successful the company is at building value for its shareholders. And they build value for their shareholders by generating sales, cash flows, and ultimately earnings. And it's earnings that drive stock prices. So with this first iterations here, we're going to look at several companies just to illustrate how FastGraphs instantly, at a glance, reflects what kind of company you're invested in. So let's start with Tupperware here. Now, this is adjusted operating earnings per share. And that's really one of the best ways to value a stock because it gets rid of a lot of non-recurring charges and stuff. Now, you can also use GAAP earnings, and you can also use basic earnings or GAAP earnings, which are diluted earnings, to draw the same kind of charts. But the adjusted operating earnings turns out to be one of the best proxies for valuation because it truly reflects how the company's operating as a business. Now, let's just look at what the FastGraph on Tupperware brands tells us. Well, first of all, it tells us since the beginning of 2004, this company really had a long streak, about 8 or 9 or 10 years here, of growing earnings. We also see that starting in 2013 and 14, 2013 earnings went flat, and then they went down, and then they really have been very erratic following that. So the point is, earnings determine market price, so they drive market price. So if you're looking for successful stocks, you want to find stocks that have a record where earnings are growing. You do not want to invest in stocks when their earnings are falling. Now, let's test the hypothesis here. Let's go ahead and put weekly closing stock prices on this graph. Remember, all we're graphing here is earnings. We're not looking at dividends or anything else. We're just looking at earnings. So this line is a 15 PE ratio. That's the orange line is drawn with. So that's multiplying every year's earnings by 15. Which is, Ben Graham said, never pay more than 15 times earnings. 15 times earnings represents a 6.67% earnings yield, which I consider a minimum yield that I would want to earn on my investments. So let's test that by adding weekly closing stock prices. Now, when I put weekly closing stock prices a couple of things ought to come to mind. First of all, in the long run, the stock price goes where the earnings went. That's clear. But there's also a lot of volatility in between. Here we have the recession of '08 and '09, and we can see that even though in this case Tupperware's earnings actually grew each year, going through the recession of '08 and '09 and even into 2012, the stock price originally fell. Now, this would have been a good time at this period of time to be investing in Tupperware as long as these earnings kept growing. Okay, but the key point is here, by looking at this graph instantaneously, you can see what kind of company and what its historical performance has been like when you're judging whether you want to add this to your portfolio or not. Now, forecasts are for Tupperware to start growing earnings again, and that could give you a reason at such a low valuation to buy the stock. But the point is, at least, that this stock has had some inconsistent history in the past. The second example, we're going to look at FMC Corporation, which is a fertilizer company. Now, I'm going to take the dividend line off of the graph, and I'm going to take the splits and spinoffs off of the graph. So once again, we see earnings growth, collapsing earnings, strong earnings growth, collapsing earnings. And when I put weekly closing stock prices on the graph, once again, we see that where earnings went, stock price was sort of follow. Okay, so we don't want to buy companies that have these kind of issues if we can help it. But I also want to point out it's going to be very hard to find companies that have perfect operating results. The next example is a company like Pitney Bowes with stamps, meters, and things. And Pitney Bowes' business really, with the age of the internet and technology, their business really dramatically changed. First of all, I see that earnings really have been dropping for 20 years, 15, 20 years. The earnings company have been going down. The price of the stock has tracked that. All right, so if you'd have bought this stock, even though it was theoretically trading at fair value or close to it back in June of '06 and held it over through February 10th of 2025, you'd have actually lost 78% of your money. And your annualized rate of return would have been minus 2.79%. And by the way, this includes dividends that the company did pay along the way. And we'll go ahead and include those dividends in here. There was a time where you were getting some dividends, but note that even the dividends were collapsing because the earnings were collapsing. All right, the next stock I'm going to show in the example would be Walgreens Boots Alliance. Now, Walgreens Boots Alliance, just to be clear, had a very excellent track record for a long period of time where their earnings grew by double-digit rates. And I can even take this back one more year, and we see that earnings grew by over 11% a year. Now, during this period of time when the company was performing well, okay, that's the secret. You want to find companies that are growing like this. Had you bought the stock when you could buy it below the orange line, when it was attractively valued, you would have done real well for yourself in the long run. But then once again, when earnings began to falter and collapse, what we quickly see is the stock price collapsed with it. And by the way, here's a lesson in valuation. Walgreens Boots Alliance had gotten ridiculously overvalued in 2015. In spite of the fact that they were doing well, the valuation was still way higher than their double-digit earnings growth during that period of time. And that made the stock very vulnerable. Valuation, first of all, was the first headwind, in my opinion, that the company faced. Then we had this strong rally, but then as earnings became apparent that earnings were flattening, the stock price fell, and then as earnings began to collapse, the stock price continued to follow that down. Earnings determine market price in the long run. Emotions determine market price in the short run. Those are two extremely important principles that need to be understood when you're looking at investing in stocks. Now, the next one I'm going to show here is United States Steel. And obviously, here's a company that had periods of earnings growth followed by earnings losses. And when I put price on the graph here, we see that over this 20-year period, the stock price didn't go anywhere. During the time when the earnings were doing well, this price did well. But once earnings collapsed, and then this erratic earnings all these years. So just to be clear, if you'd have bought this stock in the beginning here, this is not a long-term buy and hold stock, and held it for all these years, you would have made less than 1% annual rate of return. You'd have turned 10,000 into 12,000 over approximately a 2-decade period of time here because the company's earnings went nowhere. So one of the lessons here I'm looking at is you want to identify companies that have great earnings. Ford Motor Company is another popular, well-known stock. And once again, earnings lost money all going through the Great Recession. Very cyclical. Earnings rise and fall. When I put price on the graph, you can see once again the company's performance, the performance of the business. Now, the key here is if you want to invest in a stock for the long run, you want to invest in the business behind the stock. And then secondly, you want to make sure that you're fully participating in the operating results that that business can offer you. And I'll get more on that in a few moments. The next stock we want to look at is Estee Lauder. Now, I chose this one because, once again, we see a period of time here where Estee Lauder's operating performance was quite good. They dropped a little bit during the recession of 08 and 09, and of course their earnings dropped during COVID, which is this little gray shaded area here. But when I put weekly closing prices on the graph, I see a couple of things. One is that the company was pretty consistent through all these years, and the market put a very high multiple on their shares. The market was willing to put a 27 multiple. That's the PE of the blue line during this time frame. But then the stock got even way above that. Okay, so now what FastGraphs is revealing here is that valuations were very high here, but they got ridiculously high here. And then, of course, what is the moral of the story? Once earnings began to falter after these high valuations, the stock price was killed. And we had a couple of forces here. We had deteriorating fundamentals, but we also had the headwinds of an extremely high valuation where the fundamentals weren't supporting the value in the first place. So it wasn't the right company to invest in. The next one here is Dollar General. And once again, we see a stock that had really good times and then really bad times. So just to keep it short and simple for this video, during the good times, the stock did very well. If I'd have bought it while the earnings were growing here and held it up until the point where the earnings did grow, I would have made 22.7% a year on my money. But once earnings began to falter, I got a lot of volatility in the price. But as earnings then collapsed from here going forward, my rate of return now has been abysmal, minus 20% a year, only because the business did not perform as an operating business anymore. So now let's kind of summarize what I've been going through here with this video with the next two choices. The ideal company to invest in would be a stock or a business that had very consistent earnings growth. And here we've got Amdocs Ltd, an IT consulting company. You can see that they've had very consistent earnings growth over the years, averaged about just under 9%, 8.76% a year. And as you would expect, when I put prices on this graph, I would expect prices with a lot of volatility in between. I would expect prices to kind of track where the earnings of the company went. And lo and behold, that's exactly what I see. Now, I also can see clear times where they were less than optimum and times when it was really optimum. You want to buy the stock when the valuations were low, because the key here is that what you're doing is you're attempting to participate fully in what the company is capable of generating. Okay, so I'm going to scroll here and find a spot where the stock was trading at a fair value, or actually a little below that. Now, during this period of time, the stock grew earnings at 7.3% a year. Okay, I was able to buy it here at a PE of 11.54. That's a low valuation. I picked a spot that wasn't the top price there. The PE is now 12.92. Okay, so what I can expect is I'm going to get 7.34% earnings growth. I'm going to get a PE that expanded from 11.5 to 12.9. So that means I should earn more growth than 7.34%. And then on top of that, okay, I'm going to get dividend income that didn't start until 2012, but actually the dividend income has grown nicely. So I expect a rate of return better than 7.74%. And this is what I'm talking about when I say I want to invest in a good company like this, but I also want to invest at a time where I fully participate in what the company has to offer me. So if I look at performance real quick during this period of time, and I'm going to do it simply here. I'm just going to go by clicking the dots here. I end up making 9% a year on a company growing at 7% a year because I got a little bit of value creation through PE ratio expansion and I got dividend income. Now, to put that into contrast and to make my point, in contrast, if I'd have bought the stock during this period. Now let's move the scroll bar again, and let's go to a period where we're going to be buying the stock at a high valuation. All right, here the PE ratio is 18 if I'd have bought the stock on October 7th, 2005. Here we had 8% growth during this period of time. Note that the growth rates changed as I changed the time frames because I'm measuring different data. And now when I click my performance here, I ended up getting 7%. I got less than my 8.08% growth, and that included dividends. I only got 6.24% in growth. I didn't fully participate in the company, but because the company grew earnings steadily, I still made a positive rate of return over that time frame. All right, so the second secret is not just to buy the right company that produces exceptional operating results. The second trick to building a winning portfolio over time is to buy it when the valuation is attractive. Now here we have Cencora, which is a healthcare distributor, with almost perfect, consistent operating earnings growth, occasional weakness or flat year along the way. But when I put stock price on the graph, I see that the stock price tracks the earnings. And again, this would be a less than optimum time to buy the stock. These would be optimum times to buy the stock. But I'm buying a business here that has produced exceptional operating results over time. And there are many examples that I can show you for that. Like a company like Ameriprise Financial, for example, is another example of a company that grew earnings consistently. And I want you to note that they grew earnings by almost 14% a year. And had you bought the stock and is trading at fair value now, you would have made 14.9%. Again, I want to emphasize this. I want to invest in a company that I think has the ability to generate the operating results that I want. In other words, to be able to grow the business and create return through the business becoming more valuable year after year. And I want to do that at the full measure. And here I'm doing it at the full measure. The company grew by 14%, and I've got 14% growth. I add in dividend income, which the company did pay, but this isn't a gigantic dividend payer. But I add in the dividends that the company paid. We stack them on top here. I end up getting a 15.46% rate of return over a company that grew by 13% because I bought it at an attractive valuation. And by the way, if I can buy a stock like this when it's undervalued, I can even do better. It's a different time frame here, a shorter time frame, but I averaged 21% by buying the stock when it was undervalued. So the keys are you want to identify companies that are good businesses, that are growing businesses, and that are growing their earnings over time. Now, the key is you've got to stay diligent and you've got to continue to do your research and due diligence. That's why we offer the forecasting calculators, where you can look at, is the company still expected? Now, these are what-if scenarios. What if the company does grow earnings by 7% in 2025? And what if it does trade at a 15 PE? Then I would stand to make 11.5% this year. And what if it grew by another 9.88% in 2026, and again traded at a 15 PE? I could make 11% a year through 2026. And what if it grew by 17%, 16.7% in 27? I could make 13% annualized over the next 3 years, turning 10,000 into 14,000. The key is I want to buy a stock when it's attractively valued, but I also want to buy a company that is an attractive business, that has good long-term operating results, that I can invest in with confidence. Now, I've got to continue to do my homework because, as I showed you with some of these other companies, like Walgreens Boots Alliance, that had a great record and then their earnings collapsed. You've got to be on the watch for that. You want to look for companies whose Estee Lauder had great operating earnings for a good long period of time here, but then all of a sudden their operating earnings faltered, and of course the stock price faltered with it. So these are the two keys. Look for quality companies that have good potential to grow. Now, by the way, when you're looking at these companies, there's a lot of other ways you can look at these companies, and I always do, and I want to make that clear. I want to look at them if they pay dividends. I want to look at their cash flows. And here, I don't even care about price so much here with the cash flows. Some cases I do. I care that this orange line, that the cash flow is higher than the dividend growth. And then the real test is free cash flow to equity. I want to see free cash flow that's higher than the dividends paid. That means this is what's left over after spending what's to run the business. So here's a company that has a very safe dividend if I'm investing for dividend. But I also can value it by looking at the price valuation. And then, of course, the next closest thing to adjusted operating earnings would be to look at metrics like EBITDA. And again, stock looks very attractively valued based on EBITDA. It also looked very attractive, if you remember, based on earnings. Now, I can also look at other areas that are important, like sales. And here the company's trading at a reasonable price to sales, but we are expecting a drop in sales. So that would give me something to look into and figure out why. And I can do that by going into places on fast graphs like fiscal fitness. And I can look at things like what's going on with their margins. Are their margins holding steady or increasing or growing? Are they taking on any more debt? Are they buying back or issuing stock? I can go through a full analysis on these companies. But the key is I'm trying to identify companies that have the operating ability to grow my money over time. That's what my key is. And I'm investing in the business. I'm not investing in the stock, and I'm certainly not chasing the stock price. Again, if you look at this from a practical point of view, the one thing that you have to be able to say is unpredictable is the short-term gyrations in stock price. The stock price is always a very nervous line. On the other hand, if I look at the earnings and the dividend lines, they're going to be much more consistent, much more predictable, and much more reliable. Anyway, I think the keys to long-term building a portfolio of long-term success is identify good companies that have the ability to grow their businesses over time. And then second of all, to buy those companies when they're trading at attractive valuations. Don't overpay for even the best company. Be patient because as these charts will illustrate, the stock will inevitably come back to fair value and sometimes below. Anyway, this has been Chuck Carnevale, co-founder of Fast Graphs, a.k.a. Mr. Valuation. So the real secrets to building a long-term portfolio is invest in as strong an operating business as you can. And by the way, this would apply to growth stocks as well as it does to dividend-paying stocks. Look for quality companies with consistent records and the ability to grow their business over time. Do your research. Nothing takes the place of continuous, comprehensive research and due diligence. If you like the video, give me a like, ring the bell so you're alerted to new videos. Join the YouTube channel if you haven't. And to me, what makes Fast Graph such a great tool is it can instantly show you what kind of company and what kind of company's historical background and what you might be able to expect from the company going forward. And it helps you determine whether it's worth your time to do the research and due diligence that I recommend. Thanks for watching.